G'day, it's Glenn here from Precision Wealth Management. Want to do a quick video today to talk about retirement planning and investing in retirement in a high inflation environment. And that is because right at the moment we've got rather high inflation. The official number at the moment is 5.1%. Now, I'm sure a lot of people would say anecdotally that the inflation around expenses is a lot higher than that. When fuel's at least $2 a litre, lettuce is at $10 each, things are very expensive at the moment. And so inflation is having a big impact to people's cost of living. Now, when that ties into retirement planning, this is a really important lesson to be learning around retirement planning. Some people think that when you get to retirement, you should be taking on a very defensive investment plan because you can no longer work, you no longer want to take on the volatility of share markets, and you want to take a really defensive investment allocation. The problem with removing all that investment risk is it exposes you to inflation risk. Your money isn't growing, but your cost of living is growing, which is exactly the reason why a low risk investment plan for retirees should incorporate a diversified portfolio of both growth assets and defensive assets. Because over a 20 or 30 year period, if inflation is running at 4 or 5% or even higher, what happens is your cost of living goes up a lot, but your investments aren't growing, and it reduces the value of that, and it can actually have very poor outcomes for you in the future. Now, right at the moment, you might be saying, well, how do I invest with this high inflation environment that we're sort of coming into? Well, as it stands today, it's the middle of June, the investment returns from equity markets, so Australian and international share markets, say since January, is negative something percent. Markets are currently in a downturn. You might say, well, that's even worse. Not only is the cost of my living going up, but my assets are falling. And you say, well, cash or fixed interest is getting better. The RBA's put the official cash rate up, and you can get term deposits now of 2 to 3%. But again, still, that is less than the inflation numbers. So what should you be doing with your money? You might think, well, what about property? Property provides some rental income and it has good growth, but we're not guaranteed that in the future. Again, similar to share markets, what if the increasing interest rates mean that property has a negative return? Well, the answer to this is really to step back and take a much bigger view of the returns of certain asset classes over long periods of time. Yes, over short periods, share markets can have a negative return. We've experienced that now. We experienced that early 2020 with COVID. We experienced that a number of times along the way. 2012, obviously the global financial crisis in 2007, 2008, all were negative short-term periods in equity markets. But if you look over the much longer term, yes, there's downturns, but there's also a lot of up periods. So over the long term, growth assets generally do provide a return in excess of the inflation. Not over short periods. There could be a year here or a 6-month period here or there where inflation is higher than the returns you achieve. But a good retirement plan in a high inflationary market incorporates growth assets, because those growth assets are going to be the things that protect you from that high inflation devaluing your assets. If we take a look back to the high inflationary period of, say, the 80s, well, during that period, you could get actually pretty high returns from cash. And people thought, I'm getting such good returns from cash, I don't need to take on investment risk. You fast forward over the next 20 or 30 years, and the average return someone received from cash was actually fairly low, and the returns they achieved from taking on growth assets over the period were much higher. So the people that actually achieved a much lower risk when looking at the inflationary risks had an allocation to growth assets, shares and or property. So to answer the question, how should you invest in retirement in a high inflationary environment, is really to be diversified and to make sure you've got a reasonable, appropriate allocation of growth assets that's right for you. Now, what's right for you can vary. Your tolerance to risk and volatility is important. If you have too much allocated to growth assets that you're going to panic and sell in the next downturn, well then that's not right for you. Likewise, if you have such a small allocation of growth assets that it's pretty likely that inflation will mean you'll run out of money and you won't earn a high enough return, well that's probably not right for you as well. So having that right allocation of growth assets, that means your money can keep pace with inflation and provide you with the income you need, is a really important part of investing in retirement in a high inflationary market. So if you want any advice around retirement planning and investment planning, please get in touch.